Good afternoon, everybody, and welcome to this YCharts 1% Focus Report webinar. I'm Caleb Eplett. I'll be the host of your call today. I'm an account manager here at YCharts, but Eric Kobayashi-Solomon is going to be our guest speaker and kind of who you've all tuned in to hear. He's our Director of Research here at YCharts and here to share some very valuable insight with us about Ford Motor Company.
Thanks a lot, Caleb, and thanks all of you for joining today. Before we dive into the presentation, I do want to say that nothing what I'm going to present here is meant to be an offer to buy or sell securities. I also need to disclose that after I published this report, about a week after I published this report, I actually entered into a position in Ford, but none of the analysis that I'm giving here is meant to try to convince you to buy this stock. So the agenda for today, want to do a company and industry overview, take a look at Ford valuation drivers, and then we're going to finish up with a couple different valuation scenarios. So let's go ahead and dive into company and industry overview. Turns out that Caleb's family is from Michigan and has a long and proud history with the Ford Motor Corporation, so he can provide some good color to this discussion as well. So everybody on this call knows about Ford. The important things to realize about Ford is that it's primarily a U.S. maker of automobiles. If we look at the revenue share, something like 85% of the revenues are split between the United States and developed Europe, that's Germany and the UK. There are some overhangs to Ford's business. Talk about this in the 1% report. Pensions obviously are an issue for Ford, which they've been working on. Also, they have some problems with their efficiency. They had too many platforms that they were building cars on, and we'll talk about that a little bit more as we go through the presentation. So just thinking about the industry in which Ford competes, obviously it's an open and competitive industry. I lived in Japan for a few years, and during the time there I was struck by the fact that you just don't see foreign cars in Japan. It is a Japanese car market. In contrast, if you go outside your office today and take a look at the cars that are on the street, you'll see cars from Germany, from Japan, of course, from South Korea, etc. So it really is, from the standpoint of openness, a very open market and a very competitive market. The things that we're really going to focus in during this webinar, and which I focused in detail in the 1% report, are the questions: are U.S. customers willing and able to buy cars? This really factors into the demand side of the equation, which obviously is tied to revenues, which is, of course, one of the valuation drivers. The other thing that I'd like to focus on is operational leverage. A small change in volume, in other words, a small change in demand, can really create huge swings in profit, and we'll take a look at that when we look at the data. So let's take a look now at willingness and ability in the U.S. to buy cars. So this shows U.S. vehicles per 1,000 people in the population. Obviously, you can see that area in the middle, which I've identified as the golden age. This is post-war up through kind of early 1980s.
A quick question, Eric.
Yes.
Is this per 1,000 people in general, or per 1,000 people that are actually old enough to drive automobiles?
This is actually just per population. And in fact, you see that that bar that I have there at the end, which I've labeled the saturation zone. At about that level that you see we're reaching right before 1990, this is equates to about 1.3 cars per licensed driver, or 2 cars per household. Really, when you get up to that level of saturation, there's not a great desire to, or a great need to buy new cars. Obviously, during this golden age, the highway systems are being built out in the 1950s, kind of the development of the car culture. We also had more women entering the workforce starting in the 70s, so need for dual car families and so forth. So what car companies, Ford included, benefited from was not only consistent demand for its product, but also consistent demand in an expanding market. Really kind of the best of all possible worlds. So let's take a look at the next picture of kind of willingness, which is average age of automobiles. Here, what I've got is the blue line is the average age of customer cars or automobiles. Green line is average age of trucks. You'll see that there's kind of a flattening in the average age of trucks. This indicates what?
Well, a lot of people are buying new trucks.
Exactly. And if you think about kind of the timing of this, we had to switch to SUVs, where people are kind of moving from a sedan into an SUV style, which is counted as a truck. And also we have some construction and business demand. If you remember back to the introductory slide, Ford's F-Series pickup trucks are the leading car brand in the United States, selling about 90,000, I believe it was 90,000 units in 2013. And so obviously Ford is going to be tied to this kind of the business use case as well. So in terms of average age, the thing about that's kind of deceptive about this chart is you see this thing going from bottom left to upper right, see that the average age of cars and trucks is increasing. So a lot of people would say, okay, let's use a reversion to the mean, kind of an argument. The average age must kind of flatten out at 11 years or something like that. So let's bet on that happening. I actually don't believe, and we'll talk a little bit about demographic changes and also really social changes. I'm not sure that argument can be made in kind of the direct way that a lot of analysts are making it. It is true that mechanical objects wear out over time, but it's not necessarily the case that after a mechanical object wears out, it necessarily needs to be replaced. And talk about this a little bit more in the demographics section. So this chart is okay for you?
Yeah, makes sense.
Makes sense. So the next thing is these demographics. If we're talking about willingness, this is kind of a structural willingness question. We've already looked at kind of how many people own cars. We've taken a look at the average age of cars. Another thing to think about is really kind of life cycle. Young people tend to move to the suburbs and buy more cars. A couple important things to notice when we're looking at this chart. First of all, these blue bars indicate the change in the number of drivers as a percent of the population. I'm taking a look at two time periods. The first time period is the year 2000, the 2000 census, and then the second time period is the 2012 census update. There's a census taken in 2010, of course, but then further refinements were done in 2012. So I'm taking a look at Department of Energy data that investigates how many drivers you have in the population as of a certain date. And so these blue bars show that, for instance, in the 15 to 19-year-old category, there were 7% less drivers in 2012 than there were in the year 2000. So if you notice, there's a couple important things to notice. First of all, that there are fewer drivers in each age group, all the way till we get till the baby boomers. They're in the kind of 60s, mid 50s, early 60s kind of time frame. The other thing is, and the green bars, which I didn't explain before, is the actual kind of demographic distribution in the population itself. So, for instance, this 5% number here in the 15 to 19-year-olds means that there's 5% more 15 to 19-year-olds in 2012 than there were in 2000. So when you have more young people, this is relatively a good thing, on the theory that, you know, young people are going to move to the suburbs, they are going to need a minivan and a commuter car, and so this should boost demand kind of in the short term in this demographic. Kind of balancing that out, we've got a big bad mountain right here. So obviously when you've got people who are in their 60s, kind of mid 50s to early 70s, and a big group of these, you will have people driving longer, and we can see that in these blue columns right here. But the fact is that older people don't usually need as many cars. So a household that has 2 cars, maybe they realize, okay, after this one car wears out, let's just make do with one. So in general, this first green mountain we can consider kind of a positive demographic tailwind, let's say, and then this second green mountain is a demographic headwind. So the last thing about willingness that I want to talk about is a cultural shift. We talked about this a little bit when we were looking at the number of cars on the road. I mean, the 50s, this was the golden age of American transportation. The Eisenhower is building the highways. You know, an idea of a good time on Friday night was to go to the local drive-in in your car, and I think that in the United States there has been a demonstrable cultural shift, and this might seem completely out of context, but that Facebook is actually one of the things which has kind of cut back on young people needing to drive. They can experience kind of social interaction online without having to even leave their house. So it may seem far-fetched to you, but in fact, people in the auto industry are talking about kind of social media's effect on young drivers. In addition to that, we've got some other kind of trends. When I was growing up, certainly you wouldn't see bike rental inside cities. This is a really common thing. This type of photo could be taken anywhere in DC, New York, Chicago, etc. Other things about the way we're setting up communities in the 50s and 60s, people went to the suburbs. You could only get around using a car. New urbanism is a trend in architecture that says, you know, let's have everything kind of in one compact area, so you can walk to the stores that you need to walk to, etc. And the other thing is kind of these short-term car rentals, Zipcar and Uber. Have you ever used Uber?
I have, yeah.
How did you like Uber?
It was fine.
What is Uber, by the way?
Uber's similar to hailing a taxi, only instead of standing out on the corner and trying to wave down a taxi, you use an app on your phone, and you look for, typically they're going to be driving SUVs or more like town cars.
Yeah.
And you find drivers in the area and find out how much it would cost to have them pick you up and bring you to where you want to get to. And
in fact, it's not only professional drivers, right? I mean, sometimes
right. So there is a new phenomena too here in Chicago and other cities where if you're looking to make some extra money on a weekend evening, you can sign up and you can use your own car and cart some people around from bar to bar.
So in fact, this is part of the cultural shift. I mean, thinking about how we interact with our automobiles. When was the last time you went to a drive-in theater? Just about never, right? I've never been to one. Every drive-in theater I see, it looks like it's growing weeds more than customers. So thinking about these aspects of willingness, these indicators of willingness, we get kind of a mixed picture. Let's take a look now at ability. And I think of ability mainly from two perspectives. That is, let's say a stock number, in other words, the wealth that you own, and then a flow number, that is the income that you're generating, from a job or something. So this first chart looks at the cost of a vehicle as a percent of median income. Well, it turns out, and just recently, new book has come out talking about middle class wage stagnation and so forth. This has been going on for even longer than this chart might indicate. You see that the cost of a vehicle started rising rapidly in the late 1980s and kind of flattening out in the early 2000s. What this turns out to be is actually related to the dynamics of leasing. If you remember, and I'm not going to flip back to this, to the graph, but the first graph about the number of automobiles per thousand users, you remember that in the kind of late 80s it peaked.
Sure.
And then started to flatten out after that. What car companies realized is that there was not a huge amount of replacement demand. There wasn't, the market had stopped kind of growing for their product, and so to get people to buy cars more often, what they ended up doing was entering into this leasing business model, where you have a 3-year lease. The cost of a car out of pocket to you was lower, but you didn't get to keep the car at the end of the 3-year lease. It ended up being able to be sold to another customer. So these, the price of cars, even though the cost to the consumer was not any different, the price of the cars actually increased a lot. So you had a lot more kind of fancy cars getting sold, a lot more bells and whistles. And what that did is raise the average cost of a vehicle over time until it's flattened out. Now, I mean, I myself am looking for a new, let's say an SUV, that's going to set me back $50,000 if I get something new, if I don't get a lease, which is a significant percentage of most people's yearly income. So this is one trend, and this trend tends to be, I believe, more stable. In other words, it doesn't look like middle-class incomes are doing a lot of increasing, rapid increasing.
Looks like a fair amount of resistance there at 60%.
Yeah, exactly. And so this might be kind of the car companies realizing, okay, this is about as much as we can charge for a car and get people to pay for these things. The other aspect of ability is not the income, but actually the wealth. So obviously, if you have, even if your income is not increasing a lot, if your wealth, whether this be in real estate or in stocks or whatever, is high, then you feel more able to buy cars. And obviously, these data stop in 2010. And of course, 2010 is still pretty early in the housing recovery, simply because most middle-class Americans have a large proportion of their wealth in their homes. The vehicle expenditures as a percentage of median household wealth just shot up hugely. I mean, nearly doubled in the space of a couple of years. So obviously, this is going to put a damper on purchases. If you don't feel as wealthy, you're not going to purchase a expensive thing. The important thing to realize about wealth, though, is, like, Caleb, how's the stock market doing?
Right, since 2010 there, it's done quite well.
Right, exactly. And so this is the kind of measure. I mean, people tend to think about wealth as more durable, but in fact, it does undergo market fluctuations. And so, because there's a huge rise in the stock market, as we see the property market starting to kind of slowly come out of its doldrums, people are going to feel more wealthy, and perhaps because of that, feel as if they're more able to buy a car.
Guess the hope is that those younger folks that
Right.
are going to be soon to buying cars own stocks and houses, though.
Yes, exactly.
So,
That's a big part of the equation, and a big part of the kind of unknown surrounding this. So let's just sum up what we know about the willingness and ability of U.S. customers to buy cars. We know that it's a saturated market. There's kind of an uncertain timing for replacement demand. Certainly, mechanical things wear out, but we don't know how fast or kind of when that reversion is going to take place.
one interesting thing there, Eric. So when we were looking at the chart showing the average age of vehicles, that was strong and up to the right. However, when we were looking at the average or the percentage of median income that a vehicle costs, we saw that flatten out a bit.
Right, yeah.
And that's when you brought up the phenomenon of leasing.
Yes.
But you would think that leasing cars would actually have a dramatic decrease on the average age of vehicles on the road.
Yes, right. So this is all actually brought up with the idea of a scrappage rate and how fast are we scrapping these vehicles. So even after something comes off lease, that gets recycled into the economy. And so there's kind of a conveyor belt of cars, right? And so indeed, it turns out that the scrappage rate has been going down over the last 20 years as well, that people are just simply holding on to cars longer. And so a good case in point is mine. I've got a new car. I'm using air quotes for that. It's a 2006 Subaru. I'll probably have that for another, 5 years at least. I consider that my new car. It's a 2006 model. So replacement demand, uncertain, mixed picture regarding demographics. You remember we had kind of the good hill and the bad hill. And then another possible cultural shift away from automobile transportation. This is a lot harder to kind of figure out and judge.
I'm sure being in an urban environment like we are here in downtown Chicago, we feel that more than you would in a lot of areas.
Right. Yeah, exactly. I mean, there are some places where you just simply need a car to get around.
Right.
And so depending on whether people are choosing to move to those areas and start families in those areas, that's going to play into this a lot. Then on the ability side, customer income does seem to be a limiting factor, and it seems to be kind of structurally limiting. In other words, I don't see middle class incomes moving around a lot. And customer wealth, as we mentioned earlier, it's a limiting factor right now, but it's pretty easily changeable. So my personal take is this. There's some analysts, like a very prominent analyst at Citi. I know the analyst at Morningstar personally believes that there's going to be a huge surge in demand as cars start to wear out. I actually don't think that this picture is as clear or as straightforward as these analysts are making out. I think it's better not to depend on a huge pickup in demand. And I think, obviously, if I bought Ford after writing this report, I must see something that will make up for, let's say, an uncertain demand picture.
I mean, that kind of leads into a question I had, Eric. So it seems like everything we've talked about thus far is very much focused on the automobile industry in a whole.
Right, yeah.
When we look at Ford in particular and how they're different from, say, GM or Toyota, what do you have to say about that?
Yeah, so that's a good point. And the reason that I'm talking so much about the United States when I'm talking about Ford is because essentially Ford is a domestic car company. GM has a lot better and a lot more exposure in China. Ford has developed some exposure to China, and that part of its business is growing very rapidly, but their market share there is much, much smaller than GM, much, much smaller than the Japanese car companies. Obviously, Ford does have exposure to Europe, especially developed Europe, but not a lot of kind of emerging market exposure. So if you're thinking about like the difference between the car companies, and that's a really valid and a good question, I think that the geographics that the car companies are targeting, that there is a real difference in the car companies from that perspective.
Okay. And you're probably going to get into this soon, but knowing a little bit about Ford, it seems like when they tried to penetrate some of those foreign markets, they were doing that by acquiring companies that were already in those foreign markets rather than trying to distribute Ford's.
Yes, exactly. And in fact, this is true for both their European market and for South America especially. They have a good presence in South America as well. And you're right, they tended to buy local companies and just produce the companies or the designs of the companies that they acquired. This is kind of a mixed blessing. It allows them easy access into markets. However, it means that the efficiency, the number of platforms that it's building on increases. And so there's not as much efficiencies of scale. And that leads exactly into what we're going to talk about next, the valuation drivers, and that whole idea of operational leverage. So great question. So let's go ahead and turn then to the Ford valuation drivers. And I haven't mentioned this in these slides explicitly. If you take a look at the 1% reports, you'll see the three main valuation drivers that we hone in on in these reports are revenue growth, profitability, and investment level and efficacy. So we're going to take a look at each of those things here.
All right.
So we know a lot about the demand picture, and this translates into the revenue picture. Here, something I want to show you, a couple things. First thing is, this is the 0% revenue growth mark. And you can see that starting in about 2001 here, we're very close to that 0% line. And then we're even under that 0% line for a long time. This is basically a decade and a half of no revenue growth. And so just to be clear, this blue line is actually a rolling aggregate 5-year number. So what I'm doing is I'm saying, okay, let's compare the years 1990 through 1995 to the years 1991 through 1996 and show what the percentage change there is. There's a lot of advantages to looking at revenue growth this way. It's a lot more stable. You can see that this green line is the actual year-over-year growth, and it's a lot bouncier and probably doesn't give as consistent or as good a picture of what really the demand environment looks like. I think that this blue line is giving the clearest picture of the demand environment. And the demand environment, for the reasons that we've talked about, is not very good, right? We've got a saturated market, we've got people staying in their cars longer, and we've got a middle class that is increasingly finding it difficult to buy new automobiles. Another thing that I'd like you to see from this chart is we've got negative acquisitions. In other words, these are divestitures. This is true for a lot of companies, but during that golden age of automobiles in the United States, Ford really invested like there was no tomorrow. This is a tendency of humans that, they see the present environment and extrapolate the present environment into the future. It turns out that in the late 80s, that environment changed in a very material way, that simply the market was saturated. People did not need new cars as often. And this is what prompted the kind of leasing arrangement. But their capital structure or their assets were still geared to a market that's rapidly growing. And there were a lot of different, let's say, different types of customers in the market, and they were trying to sell to each of those customers. So as it became clear that there were some problems in the industry, problems including that pension overhang, problems including just overcapacity in the industry. If you remember in the 2000s, there were huge incentives that car companies were offering to clients, 0% interest for 5 years, et cetera, et cetera. So all of these things are a mark of a company that's really struggling to, keep people buying its products. Ford management, to its credit, realized that they needed to get rid of some of these assets. Some of these realizations, especially in this time period, were forced upon them because, of course, the economy was falling off a cliff. They needed cash. They needed to make sure that the company would remain a viable entity. Ford, by the way, is the only U.S. car company that didn't take a government bailout. Sure. So these divestments do have an impact on this revenue growth chart, but I believe that it probably does show something about underlying demand too. So thinking about this, would you describe this as a rosy revenue growth picture?
I can't say I would.
Let's say it's mainly mixed.
Okay.
We'll be optimistic and say mixed. Let's turn to profitability then, and you can see very clearly that dynamic that I was just talking about. Back here in the 90s, had much higher profit levels. This is kind of the switch to this leasing model. They're able to sell a lot of new cars, through the leasing programs, virtually sell the cars. And then as the market becomes more and more saturated, they're still selling the cars, but now they're having to provide a lot more incentives. What does that mean? That means taking a loss on their cars or selling them basically at cost. So you see dramatically lowered profit margins during this period. This is one of the things that I really see, and the reason that I invested in Ford actually was because I think there's a plausible argument to be made that this profitability can, maybe if it's not going to get all the way back up to 6%, at least be better than on average 2%. A couple of the things that are leading to this, we talked before about platforms. These are kind of let's say the base designs of the cars. Back in 2007, do you have any idea of how many platforms Ford operated on?
I don't know offhand, but I can tell you from just remembering all of the different cars and all of the different brands that were under that umbrella that it had to be.
It was really large, right?
Of maybe 50?
No, not 50, about half of that, 27.
25? Okay.
Yeah. But 2007, 27 platforms. Today, about 14 platforms. So they cut back a lot of, like you're saying, killed a couple brands, cut back on the number of platforms, really rationalize their platforms. They're expecting by 2017 to rationalize this further down to about 9 platforms. So what does that mean? That means that the parts that they're using for one car can be used for another car, that you don't have to reinvent the wheel every time you have a new model. That means it's more efficient operations.
I imagine that also frees up quite a bit of resources to optimize what you do have and what you are working on.
Exactly, and that brings the point up of capacity utilization. If you're realizing that demand is soft for a certain brand, but you can still produce another brand that has solid demand using the same platform, you can utilize that production line a lot more efficiently than, if XYZ car is not selling, then that production line just stops. Sure. It doesn't need to be used. The other thing that this reduction in platforms, and remember, this 27 platforms in 2007 down to 9 platforms in 2017, that's 2/3 reduction in the number of platforms. They're also looking at reducing the number of suppliers by about 40%. So really kind of taking a look at the Japanese model, the just-in-time inventories, the very tightly coupled suppliers and automakers. So and the automakers have a lot more power over the suppliers as well. So I think these kind of things, this likely gain in efficiency is really good news for Ford. And this is more than the huge revenue boost, which for me would be a nice kicker for my investment, but it's not kind of the main reason that I'd be interested in this company. I'm much more interested in this profitability picture. So the investment level, I'm not going to spend too much time on this. This is actually a bit confused. What you see here, this is negative investment, negative growth investment. This is comprised both of the divestitures. Also, it is affected by the leasing itself, the way the lease vehicles are accounted for. We'll see in a moment when we're looking at the valuation scenarios. I'm kind of ignoring these expansionary cash flow numbers and taking a look at kind of what would be a maintenance capex requirement for this company going into the future. Obviously, if you've got a saturated market, you're not going to want to be making a lot of growth investments, unless those growth investments are in different geographies. I think that Ford's plan right now is a very sensible one. That is consolidating the operations, the domestic operations that you have, making sure that those operations are profitable, and then maybe let's think about beefing up our international operations more.
And when you talk about the international operations, you have to imagine that same growth trend that we saw in terms of people buying cars and that kind of optimal picture there that we saw for that time period between the 50s and the 70s. But some of the countries right now that are emerging might go through similar booms like that. Is that something that Ford's positioned to take advantage of?
So Ford right now is not terribly well positioned to take advantage of that. They've got some growth opportunities, especially in Asia, but they really came late to the game in Asia. Henry Ford actually built his company on the kind of idea of not only selling to the American middle class, but actually building the American middle class and then selling its products to the American middle class. He treated his employees very well, paid them a much, much higher wage than they were used to.
He's hiring customers.
Yes, that's right. He was hiring his customers. That's a great way of thinking about it. Now, the thing about geographical expansion, and a lot of people are saying, okay, China, India, these are huge markets. Yes, that's true. However, take a look at China. Take a look at the headlines that you see coming out of China. I saw, for example, one headline the other day saying that a private school in Beijing had recently roofed its entire play area for its children because the air quality is just so terrible that they don't want their children basically to die because they're playing sports outside.
Sure.
So one of the dynamics that I think is a lot different for the emerging economies in terms of automobile purchases is this increased emphasis on ecology, on environmental matters, and just kind of rethinking. I think that there are countries that are rethinking whether we should build a highway system. Is there a more efficient way of doing this? Should we look more at high-speed rail? Should we look more at other kind of choices?
Flying cars.
Flying cars, that's right, powered by hydrogen. All right, so let's move on and take a look at investment efficacy. This is also a difficult picture, not only because Ford has really been disinvesting for some time, but also because of the huge operational leverage. This means the more cars that you put through a certain factory, the higher capacity utilization is, the better your profit is, and it can be very notable uptick. You know, if volume goes up by a little bit, if volume falls by a little bit, then you'll see a real profitability decrease. And here, just looking at this chart, we see exactly that. These kind of troughs, these kind of peaks, this is very typical of a company with huge amounts of operational leverage. You'll notice that if we take a look at the 5-year kind of rolling aggregate, it presents, let's say, a less noisy picture, but not a terribly good picture in terms of investing efficacy. This is saying, these dark blue bars are saying that over a 5-year period, generally profits at Ford are growing slower than the economy at large. We have a few years where it grows faster than the economy at large, or a few 5-year periods. And in fact, this huge uptick right here is a factor of both the very low starting values 5 years ago and the presence of the big downturn, and also, I would say, some of the efficiency gains that we've seen Ford make. But in general, again, I would say investment efficacy is a very mixed picture. If you're looking historically, the efficacy has been, frankly, pretty bad. And because of the operational leverage, it's a hugely variable business. This is certainly something that we should take into consideration when thinking about an investment and evaluation. So let's go ahead and turn now to valuation scenarios and take a look at kind of the scenarios that I've laid out in the 1% report. So this area right here, this table, is one that you'll see in the 1% report. What I'm doing here is I'm taking a look at the historical statistics, medium, worst, and best revenue growth over a prior 10-year period, and then kind of thinking about what I know about the industry and putting in likely worst and best case for this row, revenue growth figures. I'm doing the same thing for OCP margin, owner's cash profit margin. For those of you who haven't read through the methodology section of the 1% report, I explain OCP in greater detail there. It's basically profit margin. Looking at expansionary expenditures as a percentage of profit, and kind of thinking about what might be a reasonable maintenance CapEx requirement for the firm, and then looking at medium-term growth assumptions. The stage 3, that's the long-term assumed growth, is just a constant 6%. 6% being what? Why is 6% important?
I think that's probably what you'd have to do to keep pace with the stock market.
Yeah, and to keep pace with the economy at large. That's right. And then discount rate, I use 10% for all large cap firms. This is explained more in the methodology section. So using these inputs, what I get is a mechanical and very transparent valuation range for this company. In the best case, what we see is a boom in demand. This platform consolidation that we were talking about earlier really considerably lifts profits, lifts them in fact up to the prior level, nearly the prior level, about 5% of revenues. They continue to not have to spend a great deal on capital expenditures, but despite that, they get good medium-term growth. Here we see a fair value that's much higher than the value right now, $44 per share compared to 16 and change right now. For what I'm calling the likely case, and when I'm saying likely, what I'm trying to do is not make any grand assumptions or heroic assumptions. I'm just saying if things are about the same as they have been in the recent past, what is the likely case? This is revenues are going to grow kind of like inflation plus population growth. Platform consolidation really generates no profit increase. In other words, it's not increasing the capacity utilization much. They have to spend more on CapEx, and they get basically a GDP kind of medium-term growth. Here we get a fair value estimate of about $13 per share, about what this stock is trading for now, maybe a little bit less. Now the worst case, and this is really a worst case, I mean this is terrible. Here we have a demand shift away from cars. We have worsening profitability. In other words, this platform consolidation not only doesn't help, it actually hurts. High CapEx requirements, maybe these would be regulatory requirements. For instance, having to spend a lot more on retooling to improve fuel efficiency. And growth in the medium term of cash flows is flat. Basically, we've had flat cash flows for the last 10 years. What I'm saying is in the medium term, it'll also be flat. This worst case scenario gives us a value that's much lower, 75% lower than what the stock is trading for right now. For me, the worst case scenario is harder to see, but also not impossible, right?
Last time we saw Ford sell off in that way, we were in the middle of a massive recession. Do you think that could happen in a normal business cycle environment?
In a normal business cycle environment, it would be really hard to imagine that kind of a thing. Certainly, if we were to hit another recession, which is not an impossible thing, you really could see the market bringing the share price down to $4. And while YCharts assumes no obligation to inform people about what my personal stock position will be, I can tell you that when Ford hits $4, I'm going to be a lot larger owner of those shares. So that covers it for me. I'll turn it back over to you, Caleb. Thanks very much.
Thank you, Eric. Thank you, everybody, for joining us today. Hope everybody found it informative. I certainly learned a lot, as I always do, from Eric's presentations. I encourage anybody that would like to stay on top of these future calls and reports to follow that top link there, and make sure you're signed up to receive all updates on Eric's work. And if you do have questions about YCharts, the tools that Eric uses to do these valuations, please feel free to reach out to us at sales@ycharts.com, and we'll be certain to follow up with you very soon and get you any information that you need.
Thanks very much.
Everybody have a good day.